Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Friday, 26 September. Coming up on the show, Trump slaps new tariffs on drugs, trucks and furniture. The president also signs an order stating a sale of TikTok's US arm is ready. And after 3 straight sessions of declines, will markets get a lift when the Fed's preferred inflation data is released later this morning? So grab your coffee and let's own the morning. Well, the president was pretty busy on Truth Social last night. He unveiled a fresh round of punishing tariffs on a broad range of imported goods, including 100% duties on branded drugs and 25% levies on heavy-duty trucks, set to come into force next week. Now, stocks of pharmaceuticals across Asia fell heavily, and in fact in Australia too. And though there was an initial slump in European pharma stocks, the declines were less pronounced. It's interesting to note that GSK's London-listed shares are higher. Now remember, the UK farmer agreed to invest in the US earlier this month. Unsurprisingly, US heavyweight Eli Lilly has seen its shares rise in the pre-market, up over 1% there. Now, Trump also said he would start charging a 50% tariff on imported kitchen cabinets and bathroom vanities and a 30% tariff on upholstered furniture. All the new duties take effect from October the 1st. Additionally, according to the Wall Street Journal, the US is also planning to ask chipmakers to manufacture at home as many chips as their customers import in a bid to curb reliance on foreign supply. The Trump administration would levy tariffs on firms that do not maintain a 1-to-1 ratio over time. The plan is the result of what President Trump referred to last month when he said tech companies that invest more in the US would avoid roughly 100% tariffs on semiconductors. Now, if implemented, this could prove to be a big headache for the likes of Apple. It imports chips from all over the world. But firms like Micron and Intel, who are increasing production in the US, well, they could benefit. OK, well, here's my colleague Josh Lipton on what else you need to watch today.
All right, starting off on the Federal Reserve, we're going to be getting some more commentary on Friday from a couple of Fed officials, Richmond Fed President Tom Barkin, Michelle Bowman, the Fed's top bank cop. This coming after a big batch of commentary on Thursday, including Michelle Bowman saying that the fragile job market justifies more interest rate cuts. Speaking of the central bank, the Fed's preferred inflation gauge, that's coming out on Friday. That's personal consumption expenditures, or PCE. Economists forecasting total PCE for August to accelerate to 0.3%, while core PCE slows to 0.2% on a month-over-month basis. And finally, we're going to be getting the final reading of consumer sentiment from the University of Michigan. That number expected to hold steady compared to the prior reading at 55.4, signaling no change in consumers' attitude toward the economy. 55.4 is a historically low reading, indicating consumers still relatively downbeat about current conditions.
Well, the first thing you need to know is that the president signed an executive order last night declaring that his plan to sell Chinese-owned TikTok's US operations to US and global investors has got the green light from both Washington and Beijing. The new US company will be valued at around $14 billion. That's well short of what many analysts had estimated. Some had said the value should be closer to $40 billion. Now, the owners of the new group are thought to include Larry Ellison's Oracle, Michael Dell and Rupert Murdoch. Now, the next thing you need to know and keep an eye on is defence stocks, especially in Europe. Why? Well, European diplomats warned the Kremlin this week that NATO is ready to respond to further violations of its airspace with full force, including by shooting down Russian planes. Now remember, 3 MiG-31 fighter jets flew over Estonia, according to officials. Russia denies this and says it's not trying to test NATO. All right, the third thing you need to know about is that Meta has had discussions with Google about the possibility of using its Gemini models to improve its ad business. That's according to a report in The Information. Remember that Google and Meta directly compete in the online advertising market, and Meta has already been considering partnerships with Google and OpenAI to improve its AI features. Okay, let's get a check-in on the futures markets. We've had 3 days of declines, but September has, in the whole, been a good one. But with the threat of a government shutdown, more tariff turmoil, and uncertainty over the Fed's rate cut path, what will October have in store for us? Well, Jeremy Siegel from Wharton Business School gave his take to my colleague Julie Hyman.
I'm curious to get your view on stocks right now, though. You know, we've seen, obviously there's a little pause the last few days, but we've seen this big push higher day after day after day. Does that continue in your view? I mean, it sounds like you think the backdrop is pretty good.
I think the backdrop is good. I think we've got some more juice in this rally. It's hard to say, when, how much more. I certainly think we're closer to the top of the big increase we've had since the April lows, but I would not be surprised to see another 5 to 10% on this stock market before we level off and could have a reaction. Of course, as everyone knows, trying to predict the stock market in the short run is sort of a fool's errand. I guess I'm one of the very few academics willing to stick out his neck and and do that. I'm going to certainly be wrong a number of times, but I think I have my pulse on some of the basic market trends. I think they're still up. The end of August and September are notably very difficult months, and we're just getting, the end of September now, so we're seeing that little softening. October is usually only a bad month if September is a bad month. So a lot of people talk about crashes in October, but the truth of the matter is that crashes in October are usually preceded by dramatic declines in September. And clearly we wouldn't have not had that.
Well, small caps have been in the news this week, so if you're tempted to invest, what do you need to know? Well, my colleague Jared Blickery has the answer to that, and we'll bring you that after a short break. Welcome back. Well, this week, the Russell 2000 hit a new intraday high on Tuesday as small caps benefited from the Fed's rate cut. Now, while small caps traditionally benefit from low interest rates, which often mean lower cost of borrowing for smaller businesses, the hopes of bigger rate cuts have faded and stocks have pulled back for the past 3 days. So if you're thinking about trading small caps and the Russell 2000, there are a few key factors you need to keep in mind. Markets and data editor Jared Blickery explains in the latest episode of Stocks in Translation.
Small caps are finally having their moment, but investors still don't believe it. The Russell 2000 just punched through a 4-year bear market range to fresh all-time highs, but ETF flows are still negative on the year. And in today's Stocks in Translation, we're going to take a look at what it might take for small caps to finally soar once again. Now here's a quick lay of the land. The Russell 2000 index tracks about 2,000 smaller U.S. stocks, and basic minimums apply. They need a market cap of about $30 million, and the stock price has to be at least $1. The index is restructured with new members each June, and this so-called rebalancing is one of the highest volume days of the year. And finally, profitability is optional here, which is different from the S&P 600 that also tracks small cap stocks. That difference will matter as rates fall and money gets cheaper. Now let's take a look at the sector weights. Unlike its large cap cousins like the S&P 500 and the NASDAQ 100, the biggest sector in the Russell 2000 is industrials at nearly 20%, followed closely behind by financials with lots of regional banks. Then you get healthcare companies from biotech to services, followed by consumer discretionary, piling a bunch of retail names. And while tech is the biggest sector in the big leagues, it's only 12% of the Russell in 5th place. The Russell 2000 is just a different animal than the S&P 500. It's more domestic, more interest rate sensitive, and more tied to credit or borrowing conditions. So in theory, the Russell 2000 should diversify a portfolio filled with mega caps, but you definitely want to make sure the setup is bullish. So let's take a look at a long-term chart. This here is the big picture price action view going all the way back to 2007 in the wake of the global financial crisis. That's when the Russell 2000 bottomed in 2009 and trended up through most of the teens, which you can see in green. Then we had a bout of sideways action in blue with a nasty shakeout in the early pandemic. But stimmies, GameStop euphoria, and a global everything rally rocketed this index to new highs into late 2021. And that would be the start of a new 4-year sideways bear market that we have in orange, that we're only now starting to climb out of. You're going to see a prior attempt to break out failed in late 2024. Now, from here, we want to see if that ceiling turns into a floor or support. Time to talk money flows. Here we're using the work of Todd Sohn at Strategas ETF Research, tracking annual ETF flows of IWN and other small cap ETFs in billions of dollars since 2010. What really stands out is that 2025 is negative so far. We've already had $10 billion of outflows, and the only other year with negative flows was 2011, and that was also a negative year for performance. So despite the positive 8% return this year in the Russell, investors just don't believe this rally yet. And if new money flows don't follow the price breakout that we just had, odds favor a dip into the old trading range, what we call a false breakout. Now let's lay out the catalyst that could drive small caps higher. First, we want to see if the technicals behave. Ideally, we'd see a further rally from here, and that old price ceiling of the 4-year bear market at around 2450, that should then become support. Then we'd want to see cooperation in the form of a weaker dollar and lower interest rates from short to long term. As the Fed is now cutting rates again, this helps lower borrowing costs and it loosens financial conditions. Lower rates are oil for the economy's squeaky wheels. Then we'd like to see those ETF flows pick up again. Are investors committing actual money to small caps? That right there would be the fuel. And finally, with earnings season once again around the corner, we're going to watch out for strong earnings and guidance, especially from small banks, industrials, and healthcare services. That's the roadmap. But only price pays, as they say. So watch out for higher highs, higher lows, the charts confirming the new uptrend. And tune into Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Let's take a quick break before we dive into the early morning trading action with trending tickers. It's time now for today's trending tickers. There's a lot going on this morning, so we'll give some key highlights. First, let's check in on Intel, which is seeing significant trading volumes this morning on reports that the US may require half of its chips to be made in America, and that's sending Intel is seeking new partnerships around the world. It's now up around 4%, as you can see. There's broad effect of Trump's latest tariff announcements, and there's one big caveat though to keep in mind here. Governments and companies are seeking clarity on whether Trump's new tariff changes anything to their previously agreed deal. But here's what we're seeing already today in the markets. Wayfair, the home furniture and accessories seller, well, it's down in pre-market, and that marks a harsh stop, at least for now, to an impressive ride that saw Wayfair shares more than double in value in the past 6 months. And as you can see, they're down 3.5% in the pre-market. Next up is truck makers, and there's a clear contrast here between American and foreign stocks. While America's PACCAR jumped higher in pre-market, European truck makers are in the red. So PACCAR there up over 5%. European car makers, well, like Daimler, which has operations in the US, is set to be hit the hardest according to many analysts. Before we change subject, let's see one highlight from the pharma sector, and it's Eli Lilly. It's in the green this morning as Trump announced a new 100% tariff on some branded imported drugs. Okay, let's move on to Boeing now. The plane maker is at the center of US diplomacy again. Remember, this week, the US ambassador said a deal was being negotiated with China. And today, the US envoy says Turkish Airlines has agreed to expand its fleet with 225 new Boeing aircraft. The news follows the Turkish leader's visit to Washington, and the Boeing stock is roughly flat for now, but worth watching as we get closer to the bell on Wall Street. And finally, Oracle, the big tech, is hitting the headlines today as the TikTok deal got signed off by President Trump. Oracle is set to act as TikTok's security provider, storing TikTok user data and monitoring the algorithm and code in a new joint venture that is meant to protect national security, according to the US government. And as you can see, Oracle has given up some value after a strong rally in recent weeks. Okay, as you can tell, there's definitely a lot of deal making going on, and one of the companies that has been at the center of it all in recent days is OpenAI. Gil Laura from D.A. Davidson broke down OpenAI's new partnerships. He was speaking with Julie Hyman here on Yahoo Finance.
So this is one of the most impressive cases of fake it till you make it from Silicon Valley. That's a well-worn tradition in Silicon Valley to make big promises and hope that you can fulfill them. And that's what OpenAI is doing here. Again, as a baseline, a company that's going to have $12 billion of revenue this year, lose tens of billions of dollars, and is making commitments that they, by their count, are now $500 billion, $500 billion. The likelihood that they'll be able to live up to those commitments is quite low, which is to say it's not zero. ChatGPT does have a head start. It's very popular. It's very useful, but they're betting that they can make all these compute commitments, secure that compute, and that will somehow crowd their competitors. Not sure that necessarily can be the case, since their competitors are Google and Meta and Anthropic, which is backed by Amazon, and Elon Musk's XAI, also very well-funded enterprises, while on the other hand, OpenAI now needs to go raise this $500 billion that they've promised, and that's not trivial. Again, they may be able to do it, but for now, it just looks like a fake it till you make it situation.
Well, given that all of these other companies are now pretty reliant on OpenAI for these big commitments, right? You look at an Oracle, you look at NVIDIA, which has also invested money in OpenAI. This latest expansion of the agreement with CoreWeave, which I know you don't cover, but like, what does that mean then for that whole group of companies?
Yeah, so we have to separate in AI right now. The real companies that will do well under a wide range of scenarios, these are the big hyperscalers: Microsoft, Amazon, Google, NVIDIA, which one way or another is going to supply the chips. It doesn't matter who they're selling to. And then there's marginal players. And in fact, those are players that are entirely reliant on OpenAI. That's CoreWeave and Oracle, who are entirely reliant on OpenAI. And it doesn't matter how many more commitments CoreWeave and Oracle get from OpenAI. It's the same funny money that may or may not materialize. And that's where we're at. So we have to separate the real companies that are building out AI, and then the marginal companies that are just benefiting from the excitement and the expansion of the AI trade.
Our call of the day comes from Fortescue, the Australian miner. It says that President Donald Trump's dismissal of climate change and a tax on renewable energy won't significantly damp demand for clean power in the US, where artificial intelligence will further accelerate the shift to cheap, low-carbon energy. Fortescue CEO said that the cost of living pressures and an AI-driven surge in power use will ensure clean energy demand grows over the mid to long term in the US. He pointed to the fact that renewable energy is already more economical than coal or gas in the US despite political roadblocks. Now, Fortescue has just finalised its acquisition of Spanish renewable technology company Nabra Wind, and has signed preliminary agreements with BYD, Longi Green Energy Technology and Envision Greenwise Holdings for wind turbines, solar panels and battery storage. Now, Fortescue chairman Andrew Forrest, Australia's second richest person, on Wednesday attacked Trump's denial of climate science at a meeting in New York. Trump's administration has aggressively rolled back pro-renewable energy policies and eliminated key tax incentives since his return to office in January. That has contributed to nearly $42 billion in renewable projects being delayed, shrunk or cancelled since his inauguration. Okay, before we go, what to look ahead to next week? David Saif, chief economist at Nomura, spoke with Josh Lipton last night about what we can expect as we prepare for more key data releases and for potentially a government shutdown.
We had a great new home sales number yesterday, but that was sort of an outlier. Overall, transactional volume in housing has been really in the doldrums for years now, one could say. It seems as though the most important single factor here is what happens to mortgage rates, and it's that 10-year rate that is most important. So the key thing, or the key question is, if the Fed cuts rates, which is the short-term rate, the Fed funds rate, is that going to lead the 10-year rate to also, the yield on the 10-year rate to also decline? That's a real question. Normal times, the answer is yes, that the two of them tend to go hand in hand. But the question is here, if people think, the Fed is making a mistake here, the Fed is cutting rates in a way that's going to let inflation rise, it's going to lose credibility on inflation, investors might demand more money to lock up, more of a yield, to lock up their money for 10 or longer years. And that actually might mean that the 10-year rate might not go down, the yield might not go down in line with Fed cuts, or it could even go in the opposite direction. So that's, I think, going to be the most important determinant for, is there a recovery in transactional volume in housing, or does it remain at this very low level we've seen for the past couple of years?
Final question I want to squeeze in, possible government shutdown in our nation's capital. How do you think through that as an economist?
Well, we think that most likely the impact on GDP will be pretty limited. There will probably be a hit to GDP this quarter if it happens, but typically government workers get back pay once the government reopens. I think what's arguably more interesting here is, could we be in a situation where the Fed is flying blind because there isn't any new data coming out? If the government shuts down, we think data publications will cease. So we might not get that October 3rd employment report. We might not get that October 15th CPI report. And we could actually find ourselves on October 29th, at the next Fed meeting, in a situation where the Fed has received no new top-tier data from its previous meeting. And in that case, how could the Fed not go ahead and cut? If it said it was going to, if it indicated it was probably going to cut in October, and it doesn't have any new top-tier data, we think it would be pretty likely to simply go ahead without a reason to deviate from that.
Okay, before we go, let's get a check on the markets. Let's start with Asia. Now, shares slid in the region. No surprise that pharma stocks were hit hard here. But also, they were impacted by the fact that those bets on sharp Fed rate cuts, well, they're receding after that stronger than expected economic data we got yesterday. Now, turning it over to Europe, and now despite some, but not all European pharma names falling here, we have a sea of green, as you can see. Now, travel stocks were higher in the region. I must stress again that a lot of European companies and governments are looking for clarity after President Trump's announcement on tariffs overnight on Truth Social. They want to know whether the current deals that they've got in place will stand, or whether his new pronouncements will basically make them null and void. So we'll have to wait and see what they actually mean. And I guess that's why European stocks not in the red, as you might expect. Okay, finally, let's have a look at where Wall Street might open later this morning. Now, US stock futures, they're not really moving too much. As you can see, the Dow up slightly, the S&P and the NASDAQ down just a little bit as well there. Now, as you can see, traders, the main thing is that traders will be looking out for is that the PCE inflation data. They'll be looking at that closely, as we will be here on Yahoo Finance. Remember, we've had 3 straight days of losses amid some jitters over the sustainability of that AI boom to contend with, as well as the speculation over rate cuts as well. And remember, there's a big week coming up next week as well. Okay, that's it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.